Something unprecedented just happened in the silver market, and the mainstream media is completely silent about it. On January 9th, 2026, JPMorgan, yes, the JPMorgan, issued delivery notices for over 8 million ounces of physical silver from the COMEX vaults. But here's where it gets interesting. They're not alone. Deutsche Bank just stopped 476 contracts. Wells Fargo stopped 379 contracts. And the total delivery notices for January have spiked to 6,321 contracts. That's 31. 6 million ounces with only 4 trading days into what's supposed to be a non-primary delivery month. If you're wondering what this means for your portfolio, for silver prices, and why billion-dollar banks are suddenly scrambling for physical metal, you need to hear this. But first, if you want to stay ahead of market moves that could change your financial future, hit that subscribe button and turn on notifications. Trust me, you won't want to miss what's coming. Let's dive into what's really happening behind closed doors. Let's start with the facts, the cold, hard numbers that Wall Street doesn't want you to understand. According to the official CME clearing document dated January 7th, 2026, we're looking at delivery notices for January 2026, COMEX 5,000 silver futures contracts. Now, for those unfamiliar, each COMEX silver contract represents 5,000 ounces of silver. So when we see 1,611 contracts issued by JPMorgan Securities, we're talking about 5,000 ounces of physical silver. But here's the kicker. January is not a primary delivery month for silver. The primary months are March, May, July, September, and December. These are the months when the big players typically take or make delivery. January? It's supposed to be quiet. It's supposed to be sleepy. So why are we seeing 1,624 total delivery notices issued, and more shockingly, why have 6,321 contracts been flagged for delivery this month? That's 31, 6 million ounces, and we're barely a week into January. To put this in perspective, during a typical non-primary delivery month, you might see a few hundred contracts, maybe 1,000 at most. But 6,321? That's not normal. That's not even close to normal. And look at who's involved. Deutsche Bank AG stopped 476 contracts. That's 38 million ounces. Wells Fargo Securities stopped 379 contracts, nearly 9 million ounces. HSBC is in the mix, BofA Securities, Citigroup. These aren't small-time players or retail investors. These are the titans of global finance. Now you might be thinking, okay, so banks are buying silver, so what? Here's what. The COMEX, the commodity exchange where these contracts trade, operates on a fractional reserve system. For every ounce of physical silver sitting in their vaults, there are multiple paper claims on that same ounce. It's kind of like how banks don't keep all your deposits in cash in the vault. They lend most of it out and just keep a fraction on hand. This system works until everyone wants their physical metal at the same time. What we're witnessing could be the early stages of a delivery squeeze. When major institutions start demanding physical delivery instead of just rolling their paper contracts forward or settling in cash, it puts enormous pressure on the available supply in the COMEX vaults. Think about it. JPMorgan alone is pulling 8 million ounces. That's roughly 250 metric tons of silver leaving the vault system. And they're not the only ones. When you add up all the stopped contracts, meaning contracts where the holder is demanding physical delivery, we're looking at 31, 6 million ounces in a single non-primary month. The COMEX has reported eligible and registered silver stocks, but here's the thing about eligible silver. It's silver that could be delivered, but the owner hasn't committed it for delivery. Registered silver is what's actually available, and when delivery demands spike like this, the registered category can drain fast. If this continues, we could see a situation where paper silver prices and physical silver prices diverge dramatically. We've already seen hints of this in the past, with premiums on physical coins and bars rising well above spot prices. But if the COMEX system itself comes under stress, that's a whole different ballgame. So let's talk about what might be driving this unprecedented demand for physical silver. First, consider the macroeconomic environment. We're in an era of massive government debt, ongoing inflation concerns, and geopolitical tensions. Historically, precious metals, gold and silver, serve as safe havens during uncertain times. But silver has a unique characteristic. It's both a monetary metal and an industrial metal. Over 50% of silver demand comes from industrial applications: solar panels, electronics, medical devices, electric vehicles, and 5G infrastructure. The green energy transition alone is massively silver intensive. A single solar panel uses about 20 grams of silver, and global solar installation targets are skyrocketing. Now, here's where it gets interesting. Major banks have access to economic data and forecasting models that the average person doesn't. They have teams of analysts, direct lines to central banks, and insights into supply chain dynamics. When institutions like JPMorgan, Deutsche Bank, and Wells Fargo all simultaneously decide to take physical delivery, they're making a statement. They're saying, we believe physical silver is more valuable than the paper claims on silver. Second, there's the supply side of the equation. Global silver mine production has been relatively flat for years. Major silver mines have declining ore grades, meaning they have to process more rock to get the same amount of silver. New mine development takes 7 to 10 years from discovery to production. And here's a critical point. About 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. If those base metal mines slow down production, silver supply gets squeezed even harder. Third, and this is the conspiracy theorists' favorite, there's been long-standing speculation about price suppression in the silver market. The theory goes that large banks have used massive short positions in paper silver to keep prices artificially low. Whether you believe that or not, here's what's undeniable. If those same banks are now flipping to take physical delivery, it suggests a major shift in their market outlook. This isn't the first time we've seen stress in the silver market, and history provides some chilling lessons. Let's go back to 1980. The Hunt brothers, Nelson and William, attempted to corner the silver market. They accumulated massive amounts of physical silver and silver futures contracts. At the peak, they held about 100 million ounces of physical silver and controlled over 200 million ounces through contracts. Silver prices skyrocketed from around $6 per ounce to over $50 per ounce in January 1980. But the exchange changed the rules. They implemented Silver Rule 7, which effectively prohibited new long positions and only allowed liquidation of existing positions. The Hunt brothers couldn't maintain their position, the market crashed, and they went bankrupt. The lesson? Exchanges can and will change the rules when the system is threatened. Fast forward to 2011. Silver hit nearly $50 per ounce again during the post-financial crisis commodity boom. But it crashed hard afterward, and many suspected coordinated selling by large players. More recently, in 2021, the silver squeeze movement emerged on Reddit's Wall Street Bets forum. Retail investors, inspired by the GameStop short squeeze, attempted to squeeze physical silver by buying up coins, bars, and the SLV ETF. Premiums on physical silver spiked to 30-40% over spot prices. Dealers ran out of inventory. Mints couldn't keep up with demand. But here's the crucial difference. That was a retail-driven movement. Retail investors have limited capital and limited staying power. What we're seeing now is institutional. When JPMorgan takes delivery of 8 million ounces, they're not going to panic sell if prices drop 10%. They have deep pockets, long-time horizons, and sophisticated strategies. And that makes this potentially much more significant than any previous squeeze attempt. So what are the potential scenarios playing out from here? Scenario 1, the slow drain. Delivery demands continue at elevated levels. COMEX registered silver stocks gradually decline. Premiums for physical silver over paper prices widen. Eventually, the market reaches a tipping point where the paper and physical markets effectively separate. Those holding paper contracts find they can't get physical delivery at reasonable prices. Silver prices spike as the true supply-demand dynamics become undeniable. Scenario 2, the rule change. COMEX and CME leadership, seeing the stress on the system, implement emergency measures. They might increase margin requirements for futures contracts, change delivery rules, or even implement cash settlement-only provisions for certain participants. This would be similar to what happened with the Hunt brothers. It would temporarily suppress prices, but would also destroy confidence in the paper-silver market. Scenario 3, the false alarm. This delivery spike is a temporary anomaly. Perhaps these banks are fulfilling specific client demands or rebalancing internal positions. After January, delivery notices return to normal levels and the market stabilizes. Critics would say this was much ado about nothing. Scenario 4, the chain reaction. Other institutional players see what JPMorgan and these banks are doing and decide they want physical silver too. FOMO, fear of missing out, kicks in at the institutional level. A stampede for physical metal ensues. The COMEX system buckles under the pressure. Prices go parabolic. This is the most extreme scenario, but it's not impossible. Here's what to watch for in the coming weeks. First, monitor the COMEX warehouse stocks. These are reported publicly. If registered silver continues to decline rapidly, that's a red flag. Second, watch the premiums on physical silver products. If the premium on a Silver Eagle coin or a 100-ounce bar starts climbing from 10% over spot to 20%, 30%, or higher, that indicates physical shortage is intensifying. Third, pay attention to what the big banks do. Will JPMorgan issue more delivery notices in February? Will other banks join in, or will this die down? Fourth, watch the price action. If silver prices start breaking through key resistance levels with high volume, it could indicate the beginning of a significant move. Whether you're a silver investor, a general commodities trader, or just someone concerned about your financial future, This development has implications. For silver investors, this could be the catalyst many have been waiting for. If the COMEX squeeze thesis plays out, we could see silver prices significantly higher. However, timing is everything. Markets can remain irrational longer than you can remain solvent, as the saying goes. Don't overleverage or bet money you can't afford to lose. For those with no silver position, this might be a wake-up call to consider adding precious metals as a portfolio hedge. Historically, a Famvato's 10% allocation to gold and silver provides diversification and inflation protection. But do your own research, understand the risks, and don't chase prices. For the broader economy, a silver price spike would have ripple effects. Solar panel costs would increase, potentially slowing green energy adoption. Electronics manufacturers would face higher input costs. Some industries might need to find substitutes or redesign products to use less silver. For the financial system, if a major commodity market like COMEX experiences a delivery crisis, it raises questions about other futures markets. Are there vulnerabilities in gold, copper, or agricultural commodities? Trust in the broader derivatives market could be shaken. And here's the philosophical question. What does it mean when the biggest banks in the world suddenly prefer physical metal over paper contracts? It suggests a lack of confidence in the paper system they themselves helped create. It suggests they see risks on the horizon that make tangible assets more attractive than financial assets. So let's bring this all together. On January 9th, 2026, JPMorgan issued delivery notices for 8 million ounces of silver. Deutsche Bank, Wells Fargo, and other major institutions are demanding physical delivery. Total January delivery notices have spiked to 6,321 contracts, 6 million ounces, in what should be a quiet, non-primary delivery month. This could be nothing. It could be a routine rebalancing by sophisticated financial institutions, or it could be the opening act of the biggest precious metal story of the decade. The banks are voting with their vaults. They're choosing physical over paper. They're accumulating real metal in size. The question is, do they know something we don't? Are they positioning ahead of a currency crisis, a supply crunch, or a massive industrial demand surge? Or are they simply hedging risks in an increasingly uncertain world? Only time will tell. But one thing is certain. When the smart money moves, it pays to pay attention. The next few months will be critical. Watch the data, watch the prices, watch what the institutions do, not what they say. Because in the silver market, as in life, actions speak louder than words. And right now, the actions are screaming. If this video opened your eyes to what's happening in the silver market, please hit that like button, share this with anyone who needs to know, and subscribe for more deep dive analysis on the markets that matter. Drop a comment below with your thoughts. Do you think this is the beginning of a silver squeeze or just institutional repositioning? Thanks for watching, and I'll see you in the next one. Stay informed, stay prepared, and never stop questioning the official narrative.